Welcome back, guys. Today we will be talking about the top three stocks to buy before the new year. We will be talking about three distinct stocks and why you should buy these stocks and why I think about these stocks in the next coming years. These stocks include a wide range from growth all the way down to a recovery play from the COVID issues. So let's get started. The first stock we'll be talking about today is Alibaba. As we can see, Alibaba is down around 2.5% today. It's up around 7% on the 1 week chart. It's down around 21% on the 3 month chart and is around 10% on the upside for the year. As we can see by these trend lines, it's been going continuously up, then stagnating quite a bit, and then continuously going up. I do see, a stretch where this will continue to go up. I have a price target for this around $320 for the end of 2021. Usually I don't do price targets, but I believe this company will excel all of its expectations and earnings in the next coming quarters. So I did talk about Alibaba in my previous video. If you want more in-depth uh, talk and research about that, you should check my previous videos. Basically, just a summary of that. I think Alibaba's downward cycle was, very, 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 over exaggerated. I believe that the drop of 20 plus percent for such a valuable and good company is it's not very good. I basically said the worst punishment has already been priced into the stock, and I believe the worst punishment won't happen due to Alibaba's relationship with the Chinese government and how it's much better than what most people believe. So I consider Alibaba, the Amazon of China, and right now Amazon trades at 100 plus PE. And if you see right here, we have right now it's currently around 30. So you're getting it at a discount, but understand this is a Chinese-based stock, and the risk that come with Chinese-based stocks are evident. That's why you'll see, very very, very similar companies on the American side have higher valuations compared to Chinese stocks, even though these Chinese stocks might perform better, is just due to the sheer fact that Chinese stocks are more risky. The reason why Chinese stocks are more risky because you always have the delisting fear. You always have the fear, yeah, what is the CPC or the Chinese government going to do about this? So that's the main issue. And there's many reasons why I invested in this company. I've invested at around 265 and then I averaged down at around 220. So I'm near my uh, cost basis in total. Because there's two things. First, I believe that China's e-commerce platform will keep on growing at a faster rate than what's happening here in the US. And I like Alibaba's exposure to foreign e-commerce websites. They're trying to grow outside of China and Southeast Asia itself. So they have some deals with Thailand, Singapore. So let's see how that grows. Also, I like Ant Financial a lot. It's one of the biggest digital forms of payment in China, and I believe this will only keep going up and up in China. And I believe it's a very undervalued market in China, and it'll keep on growing. And I believe that's not priced into the stock. As you can see, it was around $100 higher than what it is right now at all time highs. So yeah. So now let's talk about another stock which I really like. This is more of a small cap stock. The stock I'm going to talk about right now is Fubo TV. I have mentioned this in my previous video as well. It did drop another 16%. On the 1 week, it's down around 30%. And it's completely flat on the 1 month chart, but we do see a spike all the way to $62. So it has fallen quite significantly. I would say it's fallen around, 55%, which is quite alarming for this type of stock. However, that's what happens with growth and volatile stocks. You'll always get fluctuations like these. But again, Fubo TV, I talked about this in my previous video. What it is, it's a digital entertainment company. They provide both streaming services and they're getting to the sports betting revenue sector. And yeah, they charge around $80 for live sports, live entertainment, live news. And in their sports betting sector, the same exact thing. They'll do, money lines, parlays, basic stuff that sports betting does. So I've invested this company at $17 a share, and I'm probably right now I'm going to dollar cost average up because I do believe this stock will continue to go up. And yeah, I love the management staff, and I think this may be, the next Netflix, like I mentioned in my previous video. Now let's talk about recovery stock, and let's see which ones are my favorite. So the last stock I recommend for the new year is Chevron. So many people believe that oil and gas is a dying sector, and they're not necessarily wrong, but oil and gas is used for a lot more things than just for cars. It's used for airplanes, petroleum based products, creams, plastics, all of that sort. So even if you take out half of gasoline powered cars, that would not equate to, an over 40% drop, in the stock in the price of Chevron, or impact the revenue so much. And plus, a lot of these companies like Chevron, Exxon, BP, and Shell are moving more towards renewable energy. So that may impact their revenue in a positive way, coupled with their bread and butter of oil and gas. So the reason I recommend Chevron over Exxon is for one main reason is that their balance sheet is really, really strong. Even through the thick of the pandemic, they're still making profits right over here. It's not a lot of profits, obviously, but in such a dire situation where oil and gas went even negative, you still have the ability um, to produce oil and gas at a profitable rate. It's quite remarkable, and I believe that these companies will become more and more efficient over the course of time, whether their production and exploration of oil will become lower, that the cost per acquiring per barrel will be much lower than it is right now. So for ExxonMobil, why I recommend this stock specifically is for two reasons. One, it's a value play. You get a nice 6.1% dividend. They are a dividend aristocrat, and they have said openly that they will 100% keep their dividend no matter what happens, which is a very good sign if you're a value investor. Second, I think this is a COVID recovery play. Most stocks have hit all-time highs, except Chevron. As you can see, it is still down 30% a year over year, and then we saw a 50% drop in March, and then another 40% drop in October. But we have seen it's kind of recovered a little bit, but still not up to those June 8th highs or those 52-week highs, in 2018 and 2019. So I expect crude oil to keep going up, and this is a recovery play essentially. So you're talking about a little over 35% upside if it does recover all the way back up, which I think is very, very feasible. I think in the next three years, Chevron will go back to all time highs, even though electric cars are, taking over supposedly. I still think there's a lot more time before that happens. So yeah, I do have a stake in Chevron. I did invest when it was around the $60 range. So I am I'm sitting pretty right now. I'm up around 50%, 45%. So even at these prices, I would definitely buy the stock. But I like my first two stocks a little bit better, Baba and Fubu. So between the three, what I like the best, essentially, I like them in order in terms of what I think presents a good value for me. I believe Baba is a big, big market cap company, and I think it'll keep on going up. I would say between the three, Baba is definitely the safest. But I think Fubu might give you the best returns out of all of them. I think Fubu, if I'm right on my thesis on saying how having a streaming platform plus having sports betting, two of the most lucrative sectors right now, this can easily be what Roku is right now, $300, $400 stock, which would indicate, 1,000%. When I mean, going to $300, $400, I mean over the course of 5 years plus. So don't expect, 500% gains in 1 year. That's very, that's not possible for most stocks. And I think between the three, the most speculative is definitely Fubo between the three, but I think the safest would be Baba. Chevron, I would say, is a good recovery play. Many people are underestimating Chevron a lot. And here's one bonus stock which people always forget, which I think may be one of the most hidden, best hidden gems in the stock market. It's probably Walgreens, right? I think Walgreens is a good dividend aristocrat. It pays really well. Their balance sheets are great, and you will always need pharmacies. But again, this is very, very risky. As you know, other players are competing like Amazon and that sort. So there you have it, folks. These are my top 3 stocks. I hope you enjoy this video. Please leave a thumbs up and have a great day.